Hello everyone, welcome to lecture number 40 of SWAM BHU course on Fundamentals of Economics and Financial Markets. Myself Dr. Anand Singh, and in this particular video I will be discussing with all of you regarding the defects of stock exchanges. That means what are the major drawbacks, what are the major shortcomings of Indian stock exchanges. Now in this particular video I will be discussing with all of you regarding some of the major defects which are concerned with highly sensitive, which are concerned with defective registration norms, the defects which are concerned with lack of professionalism, excessive fluctuations in the prices of the securities, the unhealthy and undesirable speculations, then dominance of financial institutions, then the defects which are concerned with periodic crises, the defects of poor liquidity, the opaque trading, price rigging, and the defects of insider trading. Now, let us start this particular video. Now, one of the major defect which is concerned with our, that means Indian stock markets, is concerned with, or it is said that it is highly sensitive. Now, this defect is also applicable upon all the stock exchanges, that the stock exchanges are highly sensitive. Now, what is the meaning of highly sensitive here? As such, stock market investments are sensitive. Why? Because the prices are basically fluctuating. Why the prices are fluctuating of the securities? Because of continuous demand and supply of that particular security. So, if the prices of a share are fluctuating on the basis of its supply and demand, that seems to be a reasonable, or it seems to be a genuine reason. But stock markets are also known as, or it is said that they are highly sensitive. Here the term highly sensitive basically indicates the prices are getting affected due to any reason, whether those reasons are concerned with the stock market or they are not concerned at all. That means if any specific reason is concerned with a stock market or stock, or it is not concerned at all, then also the prices of that security or that stock is basically fluctuating. And since the prices of the securities are getting affected due to a factor which is concerned with that particular stock, or it is not concerned with that stock at all, then also the prices are getting fluctuated or getting affected. That's why it is said that they are highly sensitive. Now, let us discuss this particular concept with the help of an example. Suppose there is a rumor in the market that on the next Monday or on Monday, USA is going to attack Iran, or USA is going to attack any other country. Now, suppose both the countries, they are not concerned with our country. That particular attack has nothing to do with India. But then also, since USA is going to attack Iran or any other country, if this or such kind of rumors will basically, or such kind of rumors are there in the market, then more or less there is a possibility that Indian stock markets on that specific day will crash. Why? Because such kind of news, they directly or indirectly, they are going to affect the sentiment of the market. They are going to affect the sentiment of the investors. So, such kind of news will affect the Indian stock markets also, and thereafter it will affect the prices of the securities also. Now, here the prices of the securities, suppose any company, ABC Limited company, it is listed over the Indian stock market, and it has nothing to do with both the countries. Neither its goods are supplied in USA or Iran, and neither suppose any investor from USA or Iran has making investments in that particular company. But then also there is a possibility that the stock of ABC Limited is going to be affected. Now, let us discuss this particular point with the help of another example. Suppose there is a news in the market that China is going to upgrade its technology, or China is going to liberalize its economy in 2024. With this particular news also, the Indian stock market might crash. There is a possibility that there will be a slowdown, or there will be a negative sentiments in the Indian stock market. Why? Because when there is a news that China is going to upgrade its technology, or China is going to liberalize its economy, then there is a possibility that all the foreign institutional investors who are basically invested in India or who are basically willing to make investments in India, they might either withdraw their investments from the Indian stock markets and they might go to China, or when suppose a new investor is going to make, or he was willing to make investments in Indian stock market, he might get shifted towards the Chinese stock market. So such kind of things, such kind of news, such kind of rumors, all such kind of things, if they are concerned with India or they are not concerned with India, if they are concerned with a specific stock or they are not concerned with that stock at all, in both the conditions, or you can say in all the conditions, any kind of global news, whether the news is concerned with that stock or not at all, then also the stock prices gets fluctuated, the stock prices gets affected, there is a change in the prices of the securities. So it is said that stock market investments are highly sensitive. Now let us discuss regarding the second important defect of Indian stock markets, that is defective registration norms. Now in the function segment, we have already discussed that one of the major function of Indian stock market is registration. That means only registered intermediaries are allowed to participate in the Indian stock markets. That is a very good function. It is very good that only registered intermediaries like the merchant bankers, intermediaries like the brokers, sub-brokers, depositories, custodians, etc. Only registered intermediaries are permitted to participate in the stock markets. That is a good. But what is defective here? That registration norm is defective, or defective registration norm is there. Why registration norm is defective? Let me explain this particular point. Registration norm which is prescribed by SEBI, it is basically concerned with, or that registration norm is basically concerned with capital adequacy norms. That means more or less what is the adequate amount of capital that is required to be submitted by that particular intermediary with SEBI. It is required, or it is the most important registration purpose. That means in order to get themselves as an intermediary, the organizations or the individuals, they are supposed to fulfill the capital adequacy norms. That means what is the adequate amount of capital that is required for the purpose of registration. Now here what is lacking, what is defective, that two things are not given importance, or two things are given secondary importance. Those two things are, point number one, the qualification of the intermediaries. It is basically secondary in nature. That means it is considered after capital adequacy norms. Qualification of an intermediary is a very, very important point which is basically ignored in our Indian stock exchanges or Indian capital markets. And the second thing which is basically kept at the secondary place, that is concerned with experience of the intermediary. That means how far the intermediary is experienced, whether he has proper experience or not, it is kept at the second place, and what is given more importance, that is capital adequacy norms. So registration is good, registration is mandatory, but the way of registration, that is not good. The way of registration is defective in nature, because more importance is given to capital adequacy norms and less importance is given to the intermediaries' qualifications and the experience. Now let us discuss regarding the third major defect which is concerned with the Indian stock markets, that is lack of professionalism. In Indian stock markets, we have seen that large number of intermediaries who are basically participating, who are active in our stock exchanges, they lack professionalism. They do not show professional attitude towards the stock markets. They are not professional towards their clients. They are not professional towards the investors. They are not basically concerned about the interest of the investors. And because of it, we have basically observed large number of scams, large number of big scams in the Indian capital markets. For example, I would like to discuss some of the important scams in the Indian capital markets, such as point number 1, the Harshad Mehta scam, which took place in 1991-92. What is important here? Harshad Mehta was basically a registered broker. He was a broker in our Indian stock exchanges. He was a registered intermediary. He was a registered broker. Now, the person whom SEBI has granted permission to place the orders at the trading platform of stock markets, that particular person was involved in a scam, and that is not good for the market. And because of that particular scam, or because of Harshad Mehta scandal, the stock market during that specific point of time, it basically crashed by 54%. It was a huge crash. In the same manner, there was a second scam that is called as the Ketan Parikh scam of 2001. Ketan Parikh was also a registered broker. Now, the registered brokers, they are involved in scam. Why? Because they lack professionalism. They were granted permission, or they were recognized brokers, they were granted recognition as a broker by SEBI merely by fulfilling the capital adequacy norms. Now, this particular, when the brokers are involved in the scams, they also hurt sentiments of the market. In the same manner, the Satyam fraud was there. This particular fraud, or the major participant, or the major person who was basically responsible for Satyam fraud of 2009 was the CEO, that means the Chief Executive Officer of Satyam company, that is Ramalinga Raju. Now, imagine the CEO of a big company, or the topmost leader of a company, he is basically involved in a scam. Now, such kind of things, it is simply showing that such kind of persons, the top leaders of a company, they lack professional attitude, and because of it, because of their lack of professionalism, such kind of scandals happen in our stock markets. I would also like to discuss the Sahara scam with all of you. Now, in that particular scam, the owner of that particular Sahara group, that is Mr. Subrato Roy, he was basically directly involved in this particular scam. Subrato Roy, or the Sahara scheme of 2010-11, it is said that SEBI filed a case against Sahara Group, or two companies of the Sahara Group, and the name of both the companies are SIREL, that is Sahara India Real Estate Corporation Limited, and SHICL, that is Sahara Housing Investment Corporation Limited. Now, SEBI in the year 2010-11, it filed a case against both these companies of Sahara, stating that the case was filed by SEBI in the Honorable Supreme Court, and SEBI filed that both these companies have taken a huge amount of money, a huge amount of resource from the normal investors or the retail investors by offering a security which is called as OFCD, that is optionally fully convertible debentures. And according to SEBI, such type of security do not exist, or it is not a security which is approved by SEBI. And a huge amount has been taken from large number of small investors, and the number of investors has gone past 2 crore peoples. So, SEBI filed a case, and the Honorable Supreme Court later on penalized this particular group, that means Sahara Group. Even Mr. Subrato Roy was put behind the bars. Now, here we can see that the registered brokers of SEBI, the topmost companies, or the topmost leaders, CEO of a company, that is Satyam, that means CEO Ramalinga Raju, he was involved in a crime. In the same manner, the topmost companies like Sahara, they are involved in crimes. That is simply showing that all such persons, all such intermediaries, whether they are brokers or whether they are the topmost leaders or topmost position holders of a company, they lack professionalism. Now, because of professionalism, because of lack of professionalism, basically the sentiments of the investors are hurted, and also the markets get negativity, or the market is basically affected in a negative manner. So, it is also one of the major defect of our Indian stock exchanges. Now, let us discuss regarding another defect that is concerned with excessive fluctuations in the prices of the securities. Now fluctuations that is concerned with the prices, now that is also negative. It is said that if the prices of a security, it is not fluctuating excessively, that means beyond a limit, or it is not either increasing or it is not either decreasing beyond a specific limit, then it is good. If limits are prescribed within which the fluctuations are going to happen, then it is good for any market. But if excessive fluctuations are there, suppose the prices of a security, suppose the price of a security was rupees 100, and on a specific day the price of that particular security goes from 100 to rupees 10, that means it reduced by 90%. Or suppose the prices of that security goes from 100 to 200, that means 100% increase was there. Such kind of things are not good for any stock market, or it is not good for the health of any stock also. Why? Because it demoralizes the investors' confidence. If the fluctuations are going to happen beyond a limit, then it is not good for the health of that particular stock market. It basically lower down, or it demoralizes the investors' confidence. At the same time, it makes the economy unstable. Basically, the big players, they avoid making investments in such kind of stock markets where the level of fluctuations is very, very high. Now, here we can see that basically the concept of circuit breakers has been applicable by Securities and Exchange Board of India. The concept of circuit breakers are applicable upon majority of the stocks. That means the majority of the stocks are permitted for a fluctuations of up to 5% or 10% or 15% or 20%, or in some case up to 40%. Permissions are granted for such kind of fluctuations. But it is also seen that there are large number of stocks which are listed over the Indian stock markets upon which the concept of circuit breakers are not applicable. That means the prices in that particular securities can go beyond that limit also. That means there is no circuit breaker, there is no circuits, there is no specification regarding their limits, and the trading in such kind of securities are highly sensitive. That is not basically good for the health of any stock market, or that is not good for the health of any economy. If large number of stocks which are traded over the stock markets, they are not having any kind of limits, or if circuit breakers are not applicable upon large number of stocks, then it is not good for that particular stock market. Why? Because fluctuations might be done in a very high manner or in a high ratios. So such kind of things affects the confidence level of the investors. Now let us discuss regarding one of the major defect of Indian stock market, that is dominance of financial institutions. Now in every stock market, the financial institutions play a major role. Now the financial institutions might be either a foreign financial institution or a domestic financial institution. Now whether it is a foreign financial institution or it is a domestic financial institution, both play a major role for the purpose of investment in any stock market. But how it is negative factor for Indian stock market? In the manner that in India, it is said that almost 80 to 90% of the investments which is done in our Indian stock markets, they are basically, or they have been done by the foreign institutional investors or the domestic institutional investors. That means the retail investors, or you can say the individuals, they have hardly makes an investments of 10 to 20%. That means their investments in various stocks, in all the stocks which are listed over all the stock exchanges, it is hardly between 10 to 20%. Now, it is said that in any stock market, if the number of investors, if the number of retail investors, if the number of individual investors are very high, then that stock market is safe. That stock market is quite stable. But when the number of investments done by, or the volume of investment done by the institutional investors, whether it is foreign institutional investors or the domestic institutional investors, if they are dominating over the market, if their investments is beyond a level of 80%, then that stock market is not good. Why? Because they can anytime withdraw. If a big player withdraw money from the stock market, then there will be a huge fall in the market itself. So when the domestic institutional investors or even the foreign institutional investors, they dominate over the market, then there is a possibility that because of one player, suppose one company, one domestic institutional investor is withdrawing money, then it might also affect the sentiments of the market. But when large number of retail investors are participating, then it will provide stability to the market. Now, let us discuss regarding one of the major drawbacks, that is concerned with unhealthy and undesirable speculation. Now, why unhealthy and undesirable speculation is a defect? Let us discuss regarding this particular point. Unhealthy and undesirable speculation in stocks markets can lead to economic bubbles. Now, what is the meaning of economic bubble here? Economic bubble basically indicates the unexpected increase in the prices of the security. Bubble is basically indicating a high price or unexpected rise in the prices. So, because of unhealthy and undesirable speculation in stock markets, it can lead to economic bubbles, it can lead to unreasonable prices, and at the same time it can lead to panic among investors. Also, speculation in stock trading often hurts a stock rather than helping it. That means if speculation is going on in any stock market, then instead of helping the stock, it basically hurts the sentiments of the investors in that specific stock. Also, speculation often leads to panic in volatile market. Suppose if a market is volatile itself, then if high level of speculation is going on, then it is going to affect that particular volatile market in a negative manner. Why? Because losing investors, suppose the investor is losing money in a specific stock, then those investors, they start to sell off their positions, which causes their stocks to go down even further, which leads to even more selling and so on. Suppose there is a volatile market, there are ups and downs. Suppose the prices of a specific share is falling down. Now, the investor, because of panic in the volatile market, he will start selling. Why? Speculation is going on. So, basically speculative tradings, they negatively hurt the sentiments of those kind of shares, those kind of listed securities. So, it is said that unhealthy and undesirable speculations hurts the sentiments of the markets. They hurt the confidence, they basically lose down the confidence of the investors also, and that is why it is very negative, or it is a kind of demerit point for the stock markets. Now, let us discuss regarding the next important defect, that is concerned with poor liquidity. It is said that large number of stocks which are listed over the Indian stock markets, they are having poor liquidity. Now, let us discuss this particular concept with the help of the definition of liquidity, and thereafter we will discuss regarding what is the meaning of poor liquidity. Basically, liquidity in stock market, it indicates or it measures how easily you can buy or sell stocks without affecting their prices. At the same time, low liquidity means you are not in a position to dispose your stocks at its current market prices. Also, low liquidity can also mean that orders simply fail, as no market makers are willing to provide a competitive quote at that moment of time. That means if liquidity is not there, then you are not in a position to dispose your security. Then whether you are willing to sell your securities, you are willing to dispose your security, but it is not possible to dispose your securities at the prevailing market prices. Why? Because there is not any corresponding buyer, and since there is not corresponding buyer at that specific price, so your settlements are not going to happen or your disposals are not going to happen in that specific stock. Now, it is said that almost 40 to 50% stocks which are listed over the Indian stock markets, they are hardly traded over a single day. That means only those securities are traded which are basically blue chips or topmost companies of our country, of the stock exchanges. For example, let me explain this particular point with the help of an example. Suppose there are 5,000 companies listed over Bombay Stock Exchange. As per data, almost 5,000 companies are listed over Bombay Stock Exchange, but trading in almost 2,000 or more than 2,000 companies, all those companies who have listed their securities over Bombay Stock Exchange, trading hardly happens during a specific day, during a single day also. That simply means that liquidity in those securities, those 2,000 or more than 2,000 securities which are listed over the Bombay Stock Exchange, if it is not going for a trading in those stocks are not going to happen on a regular basis or on a day-to-day basis also, that simply indicates that liquidity of those companies are very, very low. So, this is also not a good sign. What should be the best sign for a stock market? That its liquidity, a high liquidity is there. That means whenever a person is willing to deposit securities, then there must be a corresponding buyer. So, in case of Indian stock markets, most of the stocks which are listed over NSE or even BSE, they are having low liquidity. Their trading is hardly going on a day-to-day basis, or in few cases, their trading is basically going on a month basis also. Now, let us discuss regarding the next defect, that is concerned with periodic crisis. Now, all of us knows that in a country like India, almost 60 to 70% peoples, they are engaged in agriculture. All of us knows that agriculture is basically seasonal based. Now here regular incomes are not there. Here the persons are not getting salaries. So because of irregular incomes, their investments are not also regular. They are not going to make regular investments in a country like India. So it is also not a good signs. Now time to time we can witness stock market crash also. Now it refers to a sudden and significant decline in the overall value of a stock market, leading to a sharp drop in stock prices. Now because of large number of factors, because of scam or because of any international factor, our stock markets are getting affected. The stock markets are either negatively affected or in a positively affected, but if it is affected, then also periodic crises are there. Crisis is basically used in a negative sentiments, since large number of investors, they are not investing on a regular basis because they are not having regular incomes. Also the large number of negative factors, they are affecting the sentiments of the market, because of which the stock market crashes are there. So both these factors basically states that periodic crises are going on in the Indian stock markets. Now let us discuss regarding opaque trading. It is said that the transactions which are done in Indian stock markets, they are opaque. That means they are not transparent. That means each and everything, all the details concerned with our stock markets, they are not displayed by all the registered intermediaries. Basically, as compared to the stock markets of developed countries, or as compared to the developed stock markets, it is said that Indian stock market are not transparent to that level. And since they are not transparent, that's why it is said that they are, or opaque transactions are going on in the Indian stock market. Now let us discuss regarding insider trading. It is also one of the major defects which is concerned with Indian stock markets. Now insider trading is the trading of a public company's stock or other securities such as bonds or stock options based on material non-public information about the company. Now suppose any insider, that means a person which is directly concerned with the company, then he is disclosing certain informations, valuable informations, which is going to affect that particular market. Suppose the company is going to declare bonus after few days, then any person who is concerned with the company and he knows about this particular decision, then he will just disclose this particular matter to his relative, to his friend, or to anybody else. then such kind of disclosing of information by an insider, that means by a person who is concerned with the company itself, it comes under insider trading. Now, such kind of tradings are based on insider information, and such tradings are illegal in our country. Now, for example, suppose a CEO, he basically sells his shares after learning of an impending financial loss before that information is made public. Now, this constitutes illegal insider trading. Such kind of tradings are prohibited in our country. Now, SEBI has created laws to prohibit insider trading and promote fair trading. For this purpose, SEBI has passed SEBI Prohibition of Insider Trading Regulations 2015, outlined the actions that are banned. That means in this particular regulations, SEBI has disclosed certain things or certain actions which are properly banned in our country and which comes under insider trading practices. Now, let us discuss regarding the last defect which is concerned with our stock exchanges, that is price rigging. Now, price rigging in stock market is a form of market manipulation that involves parties to fix or inflate prices. That means either price fixing is going on or the price inflations, that means increase in the prices are going on. Now, it basically states that under price rigging, artificial push-ups or artificial push downs in the prices of the securities are done by the players. Now, price rigging is also known as collusions or price fixings, and they are completely banned in our country. Now, price rigging, since it is illegal, that's why the government through SEBI has the power to enforce the PFUTP regulations 2003. That means SEBI has passed SEBI Prohibition of Fraudulent and Unfair Trade Practices Regulations 2003 in order to impart control over the price rigging practices in our stock markets. Now, other market manipulations and the price rigging practices, they are also governed as per the PFUTP regulations of 2003. Now, in the next video, I will be discussing with all of you regarding a very important function that is called as listing of securities. Now, in that particular video, I will be discussing with all of you regarding the meaning of listing, regarding the objectives behind listing, that means why the companies go for listing. Then we will discuss regarding CLA, that is Central Listing Authority. We will also discuss regarding the SEBI guidelines regarding the listing of securities. And in the last segment of that particular video, I will be discussing with all of you regarding the major shortcomings or the arguments against listing. So, very thanks for watching this video.